Listen to me very carefully, because what I'm about to tell you could be the difference between a comfortable retirement and eating cat food in your golden years. I'm serious. We need to have a real conversation right now about something that terrifies me when I look at the data. And believe me, I look at data every single day. It's what I do. I'm Mr. Wonderful, and I don't sugarcoat things when it comes to your money. Before I get into the 3 safest exchange-rated funds that every retiree should own, I need you to do something for me right now. Hit that subscribe button. Smash it. Why? Because this channel is about protecting your wealth, growing your cash flow, and making sure you never run out of money. And if you're serious about your financial future, you need to be part of this community. So, subscribe and turn on those notifications, because the information I share here could literally save your retirement. Now, let's talk about what's really happening out there. I meet people every single day. Good people, hardworking people who did everything right. They save money. They put it away in their retirement accounts. They listen to their financial advisors. And you know what? They're terrified. They're absolutely terrified, because they look at the market and they see volatility. They see their account balances going up one day and down the next, and they can't sleep at night. That's no way to live when you're supposed to be enjoying the fruits of your labor. Here's the brutal truth that nobody wants to tell you. Most retirees are not prepared for a major market crash. They think they are, but they're not. They've got portfolios filled with individual stocks, or they're in funds that are way too aggressive for their age, or worse, they're sitting in cash earning nothing while inflation eats away at their purchasing power like a disease. Every single one of those strategies is a disaster waiting to happen. You want to know what keeps me up at night? It's not my own portfolio. I can tell you that. It's thinking about the millions of people out there who are one market correction away from having to go back to work at 75 years old. That's a tragedy. And it doesn't have to be that way if you know what you're doing. I'm going to tell you something that might surprise you coming from me. When you're in retirement or you're close to it, you cannot afford to be a cowboy with your money anymore. The game changes. When you're young, you can take risks. You can swing for the fences. You can put money into growth stocks and cryptocurrency and all that garbage. Why? Because you have time to recover if things go south. But when you're retired, you don't have that luxury. You don't have 30 years to wait for the market to come back. You need that money now to pay your bills, to keep your lifestyle, to enjoy your life. This is why I'm obsessed with safety and cash flow in retirement. Notice I said both. Safety and cash flow. You need both of those things working together. You can't just hide your money under a mattress, and you can't just chase the highest yields without understanding the risk. You need a strategy that protects your principal while generating income that you can actually live on. And that's exactly what I'm going to show you today. The 3 exchange-rated funds I'm about to reveal to you are not sexy. They're not going to make you rich overnight. They're not going to double your money in 6 months. But you know what they will do? They will protect you when the market crashes. They will pay you consistent dividends. And they will let you sleep at night, knowing that your retirement is secure. That's worth more than all the gambling in the world. Let me tell you why exchange-rated funds are perfect for retirees. First of all, they give you instant diversification. Instead of owning one company that could go bankrupt tomorrow, you own hundreds or even thousands of companies in a single investment that spreads out your risk. Second, they're liquid. You can sell them any day the market is open. Try doing that with real estate or a private business. And third, the fees are incredibly low compared to mutual funds. I hate paying fees. Every dollar you pay in fees is a dollar that's not working for you, not generating dividends, not compounding. Fees are the enemy of wealth. But here's where most people get it wrong. They think all exchange-rated funds are the same. They're not. There are thousands of them out there, and most of them are complete garbage. Some are too aggressive. Some are too concentrated in one sector. Some have high fees that will bleed you dry over time. And some are just poorly constructed products that are designed to make the fund company rich, not you. This is why I spent months researching and analyzing to find the 3 safest options for retirees. I looked at historical performance during market crashes. I looked at dividend yields, and dividend growth. I looked at expense rat, iOS. I looked at the underlying holdings. I looked at everything because when it comes to retirement money, you cannot afford to make a mistake. One bad decision can cost you years of financial security. Now, before I reveal these three funds, I want to make sure you understand something very important. The goal here is not to get rich. If you're retired and you're still trying to get rich, you're playing the wrong game. The goal is to preserve your capital and generate income. That's it. Boring, maybe, but you know what's not boring? Having enough money to do whatever you want for the rest of your life without worrying about running out. That's freedom. That's what we're building here. You see, when a market crash comes, and trust me, it will come, most people panic. They see their portfolios down 20%, 30%, and they sell at the bottom because they can't take the pain. That's the worst thing you can do. But with the right exchange-rated funds, you don't have to panic because you know you're protected. You know you're diversified. You know you're still getting paid dividends even when the market is falling apart. I've been through multiple market crashes in my career. I've seen people lose everything. I've also seen people who were smart, who were prepared, who barely felt a thing when everyone else was freaking out. The difference between those two groups is strategy. It's having the right investments in place before the storm hits. You don't buy insurance after your house burns down. You buy it before. So, what are these three exchange-rated funds that I trust with retirement money? I'm going to walk you through each one, and I want you to pay very close attention because the details matter here. This isn't just about buying something because it sounds good. You need to understand exactly what you own and why you own it. The first exchange-rated fund on my list is a Dividend Aristocrat fund. Now, what's a Dividend Aristocrat? These are companies that have increased their dividends every single year for at least 25 years straight. Think about that for a second. 25 years of raising dividends means they survived multiple recessions, multiple market crashes, multiple crises, and they still found a way to pay shareholders more money every single year. That's the kind of quality and stability you want in retirement. This fund is filled with companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are businesses that sell products people need. No matter what's happening in the economy, people still brush their teeth during a recession. They still buy household products. They still need health care. These are defensive businesses with incredible track records. And when you own them through this exchange-rated fund, you get all of them in one simple investment. Here's why I love this fund for retirees. First, the dividend yield is solid, usually around 2.5% to 3%. That's real cash flow you can count on. Second, those dividends grow over time, which helps you keep up with inflation. Third, and this is critical, when the market crashes, these companies hold up better than almost anything else because they're essential businesses with strong balance sheets. During the financial crisis, during the pandemic crash, these dividend aristocrats fell less than the overall market and recovered faster. That's exactly what you need when you're living off your investments. The expense ratio on this fund is incredibly low, usually around 0.35% or less. That means you're keeping more of your returns instead of paying some fund manager to underperform the market. I cannot stand high fees. They're a tax on your wealth. And in retirement, you need every dollar working for you, not working for Wall Street. Now, let's talk about the second exchange fund. And this one is all about bonds. I know bonds sound boring. Everyone thinks bonds are for old people. Well, guess what? If you're retired, you are old, at least in investing terms. And bonds are your friend. But we're not talking about just any bonds here. We're talking about a specific type of bond fund that focuses on short-term high-quality corporate and government bonds. Why short-term? Because when interest rates move around, short-term bonds don't get crushed the way long-term bonds do. They're more stable. They're less volatile. And in a rising rate environment, you're not stuck holding bonds that have lost a ton of value. You want flexibility, and short-term bonds give you that. Plus, they still pay you income. It might not be as high as a long-term bond, but the safety is worth it. This bond exchange-traded fund typically holds bonds from investment-grade companies and treasuries, which means you're lending money to the most creditworthy borrowers in the world. The risk of default is extremely low. You're not going to get rich from this fund, but that's not the point. The point is to have a portion of your portfolio that is stable, that gene, rates income, and that goes up when stocks go down. That's the beauty of bonds in a portfolio. They zig when stocks zag. During a market crash, this bond fund is your shock absorber. When everyone is panicking and selling stocks, bonds typically go up because investors run to safety. That means while your stock holdings might be down, your bond holdings are holding steady or even increasing, which cushions a blow to your overall portfolio. This is why every retiree needs bonds. It's not about being conservative for the sake of it. It's about being smart and protecting yourself from catastrophic losses. The yield on this fund might be around 3 to 4% depending on where interest rates are, and the expense ratio is tiny, often under 0.1%. You're basically getting institutional quality bond management for almost nothing. That's a fantastic deal, and it's one of the reasons I prefer exchange-rated funds over trying to buy individual bonds yourself, which is complicated and expensive for most people. Now we get to the third exchange-traded fund, and this is the one that really brings everything together. This is a balanced fund that holds both stocks and bonds in a conservative allocation. Think of it as a one-stop shop for retirees who want simplicity. You buy this one fund and you get instant diversification across asset classes without having to rebalance yourself or worry about getting the mix right. These balanced funds typically hold around 40%. Stocks and 60% bonds, or sometimes 5,050, depending on the specific fund. The stock portion gives you growth and dividend income, while the bond portion gives you stability and safety. It's the best of both worlds wrapped up in a single ticker symbol. For someone who doesn't want to think about investing every day, who just wants to set it and forget it, this type of fund is perfect. What I really like about these balanced funds is that they automatically rebalance for you. When stocks go up a lot, the fund sells some stocks and buys more bonds to get back to the target allocation. When stocks crash, the fund does the opposite, buying stocks at cheaper prices using the bond holdings. This forces you to buy low and sell high, which is exactly what you're supposed to do. But most people can't because their emotions get in the way. The fund does it automatically, which removes human error from the equation. The returns on these balanced funds are not going to blow your mind, but they're consistent and predictable, which is what you need in retirement. Over time, you can expect something like 5 to 7% annual returns on average with much lower volatility than an all-stock portfolio. And most importantly, when the market crashes, these funds don't fall apart. They might drop 10 or 15% instead of 30 or 40%, which means you can stay calm and stick to your plan instead of panicking and making terrible decisions. The expense ratios on these balanced funds are also very low, typically under 2%. You're getting professional asset allocation and rebalancing for basically nothing. Compare that to paying a financial advisor 1% of your assets every year, and you can see why I love these funds. You're saving thousands of dollars in fees while getting the same or better results. Now, here's the strategy one recommends for most retirees, and this is important, so listen carefully. You don't have to pick just one of these funds. In fact, you probably shouldn't. The smart approach is to use all three together in a way that matches your personal risk tolerance and income needs. If you need a lot of current income, you might put more weight into the Dividend Aristocrat Fund and the Bond Fund. If you can afford to take a little more risk for growth, you might add more of the Balanced Fund. The key is to build a portfolio that lets you sleep at night. I've seen too many retirees who were talked into aggressive portfolios by advisors who promised them the moon, and then when the market dropped, they couldn't handle it. They sold at the worst possible time and locked in massive losses that they'll never recover from. That's a tragedy, and it's completely avoidable if you build your portfolio the right way from the start. Think about it like this. If you have $1 million saved for retirement, you might put $300,000 in the Dividend Aristocrat Fund, $300,000 in the Bond Fund, and $400,000 in the Balanced Fund. That gives you diversification across different strategies and different asset classes. You've got income from dividends, safety from bonds, and growth potential from the balanced mix. When one part of your portfolio is down, another part is likely holding up or even going up. And that's the beautiful thing about this approach. You're not putting all your eggs in one basket. You're not relying on one strategy or one asset class to carry you through retirement. You build a fortress around your money. And when the storms come, and they will come, you're going to be fine while everyone else's are you. Ning around with their hair on fire. Let me tell you what happens when you don't have this protection in place. I've seen it happen over and over again. The market is doing great. Everything is going up. People are feeling confident, maybe even cocky. They think they're investment geniuses because their portfolio went up 20% last year. Then boom, a crash hits. Maybe it's a financial crisis. Maybe it's a pandemic. Maybe it's something we can't even predict right now. Suddenly, their portfolio is down 30, 40, 50%. And because they need that money to live on, they're forced to sell at the absolute worst time just to pay their bills to that death spiral. Once you start selling in a crash, you're locking in losses that you can never get back. And here's the worst part. When the market eventually recovers, which it always does, you don't participate in that recovery because you already sold. You got out at the bottom, and now you're sitting in cash watching everyone else make money while you're trying to figure out how to make your remaining savings last another 20 years. It's a nightmare, and it's completely preventable. This is why the 3 exchange-rated funds I just told you about are so critical. They're designed to prevent that nightmare scenario from ever happening to you. The Dividend Aristocrat Fund keeps paying you dividends even when stock prices are falling. The Bond Fund provides stability and often goes up when stocks crash, and the Balance Fund automatically rebalances to take advantage of market volatility without you having to do anything. Together, they create a portfolio that can weather any storm. But here's what you need to understand about market crashes. They're not rare events. They happen regularly. If you're going to be retired for 20 or 30 years, you're going to live through multiple crashes. That's just a fact. The question is, are you going to be prepared for them, or are you going to be a victim of them? The choice is yours, but you have to make that choice now before the next crash happens. I want to talk about something that doesn't get enough attention, and that's the psychology of retirement investing. This is where most people fail. Not because they picked bad investments, but because they couldn't handle the emotional roller coaster. When you're working and putting money into your retirement account every month, a market crash is actually a good thing because you're buying more shares at lower prices. But when you're retired and taking money out, a crash feels terrifying because you're watching your nest egg shrink while you're still spending from it. This is called sequence of returns risk, and it's one of the biggest dangers retirees face. If you retire right before a major crash and you're forced to sell shares at low prices to fund your lifestyle, you can permanently damage your portfolio's ability to last. But if you have the right mix of assets, if you have those bonds and dividend-paying funds providing stability and income, you don't have to sell your stocks at the bottom. You can live off the safe parts of your portfolio and let the stock portion recover. That's the whole game right there. Let me give you a real-world example. During the financial crisis, the stock market fell about 50% from peak to trough. If you had all your money in stocks and you needed to take out $50,000 a year to live on, you were selling twice as many shares to get that money compared to before the crash. That's devastating. But if you had a portfolio like the one I'm describing with bonds and dividend funds, you could have taken that $50,000 from those stable sources and never touched your stocks. A few years later, when stocks recovered, your portfolio was in great shape instead of being permanently crippled. This is why I'm so passionate about this strategy. It's not theoretical. It works. I've seen it work through multiple crashes. I've seen it protect people's retirements while their neighbors who were in aggressive portfolios got destroyed. The difference between success and failure in retirement often comes down to how you handle the crashes. And the best way to handle them is to build a portfolio that doesn't force you to make terrible decisions under pressure. Now, I want to address something that I know some of you are thinking. You're thinking, Kevin, these funds sound safe, but what about growth? What if I live to be 95? Won't I run out of money if I'm playing it too safe? It's a good question, and here's my answer. First of all, these funds do provide growth. The dividend aristocrats grow their dividends over time, which means your income is increasing. The balanced fund has stock exposure, which grows over time. You're not sacrificing all growth for safety. You're finding the right balance. Second, running out of money is not just about how much your portfolio grows. It's also about how much you spend and how you handle volatility. If you have an aggressive portfolio hack crashes and you panic and sell, you'll run out of money much faster than someone with a conservative portfolio who stays calm and sticks to the plan. Behavior matters more than returns in retirement. I cannot stress that enough. Third, you can always adjust. If you're 70 years old and your portfolio is doing great and you want to take a little more risk, you can shift some money into more growth-oriented investments. But you do that from a position of strength, not desperation. You make calculated decisions based on your situation, not emotional decisions based on fear or greed. That's how wealthy people think about money. And that's how you need to think about it, too. Here's another thing I want you to remember. The goal of retirement is not to die with the most money. The goal is to live the life you want without running out of money. That might sound obvious, but you'd be surprised how many people forget that. They're so obsessed with growing their portfolio that they don't actually enjoy their retirement. They're afraid to spend anything because they're worried about the future. That's no way to live. With the right portfolio in place, with these 3 exchange-traded funds working together, you can spend confidently. You know you have stable income coming in. You know you're protected against crashes. You know your money is going to last. That confidence is priceless. It allows you to actually enjoy your retirement instead of spending every day checking your account balance and worrying about the market. Let me tell you what you need to do right now. If you're not already invested in funds like these, you need to make a change. I don't care if you have to sell some individual stocks or get out of some risky investments. Your retirement is too important to gamble with. Open a brokerage account if you don't have one and start building this portfolio. You can do it yourself in about 20 minutes. It's not complicated. You're buying 3 funds. That's it. And here's the beautiful part. Once you set this up, you barely have to touch it. Maybe once a year you rebalance, a little bit if things have gotten out of whack. Maybe you reinvest your dividends or take them as cash depending on your needs. But for the most part, you set it and forget it. You're not day trading. You're not watching the news every day freaking out about what the market is doing. You build a machine that generates income and protects your wealth. And now you just let it run. This is what smart money does. This is how you survive market crashes. This is how you make sure you never have to go back to work at 75. And this is how you leave something behind for your kids or your favorite charity when you're gone. It all starts with having the right foundation. And that foundation is built on safety, diversification, and cash flow. Before we wrap this up, I need you to do something for me. If this video helped you, if you learned something valuable, I want you to hit that like button right now. It helps other people find this information, and more people need to hear this message. Too many retirees are making mistakes that are going to cost them everything, and we need to get the word out. And if you haven't subscribed yet, what are you waiting for? This channel is all about protecting your wealth and making smart money decisions. I'm putting out content regularly that can change your financial life. Subscribe, hit the bell so you get notified and become part of this community. We're building something special here, and I want you to be part of it. Leave me a comment below and tell me, are you going to implement this strategy? Do you already own funds like these? What's your biggest fear about retirement? I read the comments and I love hearing from you. This is how we learn from each other and get better with our money. Listen, I know I come across as tough sometimes. I know I don't sugarcoat things, but that's because I care about your success. I've spent my entire career building wealth and helping other people build wealth. And I've learned that the truth is more valuable than making people feel good. The truth is retirement is scary if you're not prepared. But if you are prepared, if you have the right strategy, it can be the best time of your life. You worked hard for decades. You saved money. You sacrificed. You deserve to enjoy your retirement without stress and without fear. And the 3 exchange-rated funds I just shared with you are the foundation of making that happen. They're not exciting. They're not going to make you a millionaire overnight, but they're going to protect you when it matters most. Remember, in retirement, it's not about hitting home runs. It's about not striking out. It's about staying in the game long enough to win. And with these funds in your portfolio, you're going to stay in the game no matter what the market throws at you. That's a promise. That's Mr. Wonderful's guarantee to you. Now get out there and take control of your financial future. Build that portfolio, protect your retirement, and live the life you deserve. Thank you for watching, and I'll see you in the next.